Authorized push payments fraud or app fraud is one of the most damaging bank scams in the world right now, and the cruel part is that victims send the money themselves. In this video, I will explain what authorized push payment fraud is, how app scams actually works, how to spot one even before you send a single penny, and how to protect yourself and your customers. These scams works by manipulating you into making a real payment from your real account to an account that you believe is legitimate. And by the time you realize, the money has usually moved on. So let's jump into today's video. What is authorized push payment fraud? Authorized push payment fraud happens when someone manipulates you into sending money directly to a fraudster's account while you believe that you are paying someone legitimate. Because you authorize the payment yourself, it is much harder to recover that card fraud. It sits at the intersection of fraud and money laundering. The funds move quickly through a chain of mule accounts, and that layering is an AML concern, even though the entry point is a scam. The scale is very significant. UK Finance reported app fraud losses in the UK reached £213.7 million in the first half of 2024 alone, and in the US the FTC reported bank transfer and payment scam accounted for the highest losses of any payment method in 2024. So let's see how it works. App scams comes in few recognizable forms. The first one is impersonation scams. The fraudster poses as your bank, a government agency, or the police and tells you to move funds to a safe account immediately. The urgency here is engineered to stop you thinking clearly. Another example is invoice and supplier fraud. A business receives what looks like a genuine invoice from a known supplier, so a company that you're already familiar with, but the bank details have been quietly changed. So common in conveyancing, legal services, and corporate procurement. Another example is romance scam, also sometimes called pig's butchering. It's not a very good term, but let's call it romance scam. The victim builds an online relationship with someone who eventually has a financial emergency. The FBI IC3 recorded over $650 million in losses to confidence and romance scam in 2023 alone. One more example is investment scams. Victims are drawn into a fake platform with convincing interfaces and small early return until they try to withdraw. So what they all share is social engineering. The scam doesn't exploit a system weakness, it exploits the human one. Before we continue, a word from this video sponsor, Coveron. Everything that I've just described, the impersonation called the convincing invoice, the fake investment platform, these scams works because they're designed to, and they target people at a moment of pressure, urgency, or even trust. Coveron is an identity and financial protection service from North Security. One thing directly relevant to today's topic: for US citizens, Coveron provides up to $10,000 in coverage for eligible losses to scams or online fraud. So if a scam succeeds and the transfer goes through before anyone can stop it, you are not left alone with no financial backstop. It also monitors your accounts and alerts you to suspicious activities, which adds an early warning layer before things escalate to a transfer. Find out more by visiting Coveron website at coveron.com/FinCrime agent or tap the link that you will find in this episode description. And remember, Coveron is available for now for US residents. So how do we spot this type of fraud? For you as an individual, the warning signs are almost always about pressure and change. Anyone telling you to move money urgently to a safe account, that's a red flag. Your bank will never ask you to do that. A supplier bank's detail that change at the very last minute, that's another red flag. So is any investment that pressures you to act fast or block you from withdrawing. For institutions, the difficulty is that the sending bank just see a customer making a payment to a payee. Unless there are behavior signals, an unusual amount, a brand new payee, out of pattern timing, nothing looks technically wrong. That is why the industry has moved towards a behavioral friction, confirmation of payee checks, real-time warning before large transfer to new payees, and in some cases deliberate cooling off period. How to protect yourself? Almost every app scam relies on urgency, so the single best habit is to pause and verify independently. Call your bank on the number on your card, not the number that is provided in the message, for example. Never move money to a safe account. Confirm any changed bank details by phone with a known contact that you already have in your contact list. And remember that if it's a genuine opportunity, that will survive if you take an extra day to check it. And if you are protecting customers, customer friction at the point of payment is now a control, not an inconvenience. In the UK, the PSR's mandatory reimbursement framework, in force since October 2024, requires payment service provider to reimburse app fraud victims up to £85,000 per claim in most cases. So your financial exposure has increased materially. In the US, the picture is more fragmented, with expectation varying by payments rail and institution. Let's now move into the compliance and anti-money laundering angle. App fraud doesn't end when the victim makes the transfer. What happens next is a laundering problem. The funds land in a mule account, often a recruited mule, then move fast, broken into smaller amounts, sent across multiple accounts, often converted also now to crypto and withdrawn as cash. That downstream flow is your transaction monitoring problem, and the suspicious indicators come from the speed of onward transfer, receipts from multiple sources, and the absence of any credible economic rationale. FinCrime has highlighted the link between app-style fraud, inflow, and money mule networks. Your SAR should reflect both dimensions, the suspected fraud and the suspected laundering, and identify the network indicators connecting the mule accounts to others. If you want to develop practical structured knowledge across anti-money laundering typologies and investigations that holds up in front of an auditor or a regulator, my FinCrime Career Accelerator is built exactly for that. I will leave you the link fincrimeagent.com/online course right here, and you will find it also in the description of this video. So, to recap, authorized push payments fraud works by manipulating you into authorizing the transfer yourself, which makes it hard to recover and harder to detect. The types can vary. It can be impersonation, invoice fraud, romance, investment, but the mechanism is always social engineering. You spot it by recognizing engineered urgency and verifying independently before you actually make the transfer, before you pay. You protect against it as an individual by slowing down and checking as an institution through payments friction and, in the UK, mandatory reimbursement. And because the money is then laundered through mule accounts, it's both a fraud and ML problem at once. If you found this useful, do press the like and subscribe to my channel, or even share this video with someone on your team that maybe is dealing with app fraud or scam typologies. And thank you again to Coveron for sponsoring this video. I'm Marco Beranzoni, and I will see you in the next one.